Most people think investing is risky, complicated, or only for rich people. That is why they stay stuck working for money instead of letting money work for them. Today, I will break investing down in the simplest way possible, without jargon, hype, or scams. What investing really is. Investing means putting your money into assets that can grow over time. Instead of saving money and losing value because of inflation, investing helps your money grow faster than inflation. Common investments include stocks, ETFs, index funds, bonds, and real estate. Always remember, investing is not gambling. But wait, what is stock and ETF? A stock means you own a small piece of a company. When you buy a stock, you become a tiny owner of that business. If the company grows and makes more money, your stock can increase in value. You can then sell it later for more than you paid. ETF stands for Exchange Traded Fund. But forget the complicated name. An ETF is simply a basket of many stocks grouped together. Instead of buying one company and taking a risk, an ETF lets you buy hundreds or even thousands of companies at the same time. For example, one ETF can include companies like Apple, Google, Microsoft, and many more. This makes investing safer for beginners because your money is spread out. That is why ETFs are recommended for people who are just starting. Why most beginners fail. Most beginners lose money because they chase fast profits. They follow social media hype. They invest money they cannot afford to lose. So if you avoid these three mistakes, you're already ahead of most people. So how to deal with that? Step 1. Build your foundation. Before investing, you need an emergency fund. This should cover 3 to 6 months of expenses. An emergency fund protects you from panic selling and gives you confidence to invest long-term. You should also pay off high-interest debt such as credit cards. If your debt interest is higher than your investment return, paying debt comes first. Step 2. Choose a broker. A broker is the platform that allows you to buy and sell investments. You cannot invest without a broker. Think of a broker as the bridge between your money and the market. When choosing a broker, look for low fees, beginner-friendly apps, and strong security. Many brokers allow you to start with small amounts of money. Some brokers also offer automatic investing, which is great for beginners. Examples of beginner-friendly brokers include platforms that offer ETFs, index funds, and fractional shares. But what is an index fund? An index fund is similar to an ETF. It follows a specific market index, like the top 500 companies in a country. Instead of trying to beat the market, an index fund copies it. Step 3. Best investments for beginners. Index funds and ETFs are the best choice for most beginners. They spread your money across many companies, which reduces risk. You're not betting on one company but on the entire market. Historically, the market grows over the long term. Dividend investing is another beginner-friendly option. A dividend is money that a company pays you just for owning its stock. You do not need to sell anything to get it. If the company makes profits, it shares part of that profit with shareholders. For example, if you own a stock that pays a dividend of $2 per share and you own 10 shares, you receive $20. This money is usually paid every 3 months. Think of dividends like rent. You own the asset and it pays you regularly. This creates passive income over time. Beginners should avoid day trading, signal groups, and guaranteed profit schemes. If someone promises fast money, they are usually making money from you. Now, the big concern is, how much money do you need to start? You do not need thousands of dollars to begin. You can start with 10, 50, or 100 per month. What matters most is consistency, not the amount. Investing small amounts regularly beats trying to time the market. A simple beginner strategy. Invest monthly using dollar cost averaging. Stick to ETFs or index funds. Hold your investments for the long term, ideally 10 years or more. Markets go up and down, but over time they trend upward. Why beginners should start with ETFs and index funds. You do not need to pick winning stocks. You do not need to predict the market. You simply invest regularly and let time do the work. Final tip. You do not need to be perfect to start investing. You just need to start. Small, consistent steps can change your financial future over time. Comment below and tell me what you want to see next. Like the video, subscribe, and turn on notifications for more beginner-friendly investing content.